And investors have been digesting this news of the rate hike, with some raising some concerns that it may actually bring in more hot money into China. I want to bring in Carl Weinberg. He's the chief economist and founder of High Frequency Economics, joining us by phone. Talks a lot about China. And Carl, is there a real concern, or is that just hogwash, that this could actually create more speculation into the Chinese markets?
Well, yeah, Betty, I think there is a real concern in the markets, and yes, I think it's hogwash, so I agree with you on both accounts.
Okay, how is that possible, Carl?
Well, I think a lot of people are concerned that this is going to bring some more hot money into China, and it might, but the increase is in affecting domestic deposit rates and the interbank market. And it's really hard for foreigners to bring money into those markets to take advantage of this.
Right.
So while the opportunity may be there on paper, the liquidity and the assets that benefit from this interest rate increase are really almost entirely domestic.
And don't forget, right, Carl, that we're just talking right now about a 25 basis point hike.
Yeah, it's not going to change the world for sure. And I think that what they're really aiming at here is slowing the economy, but also trying to absorb some of the vast amount of liquidity that came into China because of the foreign exchange reserve increase that was just reported for the third quarter.
Right.
We saw $193 billion flow into China's foreign exchange reserves, and that'll have a counterpart that's popping up in the money supply and bank lending even now. They want to avoid a multiplied increase in credit, so they're raising interest rates in conjunction with a rise in banks' reserve requirements,
right,
and selling a lot of bank bills to try to mop this up. I think this is just one small part of a bigger operation to try to sterilize the foreign currency inflow.
Right, they're pulling several levers, and all of this, though, Carl, is that is all of this going to work in terms of keeping that property bubble cooled down?
Well, I think the property bubble is one objective here, but when we look at the whole picture in China, of which the property market is really only a very small part, we're going to get a GDP number tonight that's going to be somewhere around 10%, which looks like it should be scary from our perspective in the Western economies. But in fact, 10% GDP growth is really just par for them. It's just their potential growth rate. And I don't think they're as concerned about runaway economic growth as we are. They now, if we get a number of 10% or greater on GDP, we'll have enjoyed 3 quarters of above potential growth after 6 quarters of below potential growth. I don't think they're really anxious to step on the brakes that much. They just want to make sure that their money supply doesn't take off to cause problems for them later on.
Because because Carl, aren't the Chinese more sensitive to inflation? I mean, what we see as perhaps not as big a problem, even a very tiny increase in their inflation rate could have huge implications for a country where people earn barely $30 to $40 a month in the rural areas. Do you know what I mean? I mean, it's a much more sensitive situation there.
Well, I think that's right, Betty, and we are going to get CPI numbers also overnight tonight. We're looking for about 3.5%, which would be little changed for September than what we saw in August. But the pernicious part of this is that the biggest bulk of the increases is coming from food prices, which are up by over 6% year over year. And food price increases make poor people poorer, and that is a possible lever for social unrest within China's otherwise harmonious economy. So I think that seeing the concern about inflation is important, but remember, the inflation is coming from food, and there's no interest rate in the world that'll bring down food prices. So they really have another problem behind this price increase that they have to address, which is ensuring adequate food supplies for the people.
Okay, Carl, nice to talk with you as always. Carl Weinberg of High Frequency Economics.